And we are back. I do apologize about that, guys. We'll continue on and we're going to the fourth section of this. All right. This is the industry overview. Sorry. I'm sorry. I do apologize. All right. The insurance industry plays an important role in our society. The majority of American households owns some form of life insurance. In 2009, the average face amount of a newly purchased individual life insurance policy was 172,000. Premiums for life insurance policies totaled to 125 billion in 2009, a 15% decrease from the previous year. Annuity premium receipts decrease of 29% in 2009 to 232 billion. The amount of paid out benefits dividends, annuity payment, and surrendered values exceeded 375 billion. Most new life insurance policies and purchased by individuals from life insurance agent, according to the American Council of Life Insurers 2010 Life Insurers Fact Book. Americans purchased 2.96 trillion of new life insurance coverage in 2009, 2.6% less than the 2008. Life insurance in force in the United States at the end of 2009 totaled over 18.1 trillion, a 5% decrease from 2008. New York Stock Exchange, for example. The health insurance industry is also vital to our national well-being. In 2008, U.S. Census Bureau statistics indicated that 250 million Americans, or 80% of the population, had some form of health coverage. About 201 million, or 79% of the insured population, had private insurance, and 88%, or 176 million, participated in employer-based health programs. The number of people covered by government insurance program, primarily Medicare, increased in 2008 to over 87 million. Despite these impressive coverage statistics, the uninsured population in America continues to increase. There is no simple profile. I do apologize. So this is what happened when you speak multiple languages. That's also a flaw. For the uninsured, about 10 million people, or 22% of the uninsured population, or non-U.S. citizen. 32 million, or 70%, have family incomes below 50,000 per year, and 14 million, or 30%, are eligible for state or federal health benefit but have not enrolled. The insurance industry makes a substantial contribution to our national economic states, as far as go, the insurance industry makes a substantial contribution to pretty much to our nation's economy. It is a significant source of investment funds, because insurance company invest the billions of premium dollars they receive annually in a wide range of investment. The insurance industry is one of the most efficiently organized and effectively operated industries in our country. The purpose of the chapter is to provide a broad overview of the insurance industry, how it operates, and how it is regulated. Reserves are the accounting measurements of an insurer's future obligation to its policyholders. They are classified as liabilities on the insurance company's accounting statement, since they must be settled at a future date. Liquidity indicates a company's ability to make unpredictable payouts to policy owners. Types of insurance companies. There are many ways to classify an organization that provides insurance. In the broadest of terms, there are two classifications: private, also called commercial, and government. Within these two classes are many categories of insurance provided, as well as insurance plans and insurance producers. Private insurance companies. Commercial. Private insurers offers many lines of insurance. Some sell primarily life insurance or annuity, while others sell accident and health insurance or property and casualty insurance. Companies that sells more than one line of insurance are known as multi-line insurers. Below is a list and description of the different types of private insurers. I'll give you guys some examples as we speak. Actually, let's speak in regards to stock companies non-participating. A stock insurance company is a private organization organized and incorporated under states laws for the purpose of making a profit for its stockholders. It is structured the same as any corporation. Stockholders may or may not be policyholders when declared stock dividends or paid the stockholders. In a stock company, the director or an officers are responsible to or for the stockholders. A stock company is referred to as a non-participating company because policyholders do not participate in dividends resulting from stock or ownerships. Mutual company participating. Mutual insurance companies are also organized and incorporated under states' laws, but they have no stockholders. Instead, the owners of the policyholders. The owners are definitely the policyholders. Anyone purchasing insurance from a mutual insurer is both a customer and an owner. He has the right to vote for members of the board of directors. By ensuring a participating policies that pays policy dividends, mutual insurers allows their policy owners to share in any company and earnings. Essentially, policy dividends represent a refund of the portion of premium that remains after the company has set aside the necessary reserve and has made deduction for claims and expenses. Policy dividends can also include a share of the company's investment mortality and operating profits. Surpluses are typically distributed to policy owners on any annual basis. Mutual companies are sometimes referred to a participating company because the policy owners participate in dividends. Occasionally, a stock company may be converted into a mutual company through a process called mutualization. Likewise, mutuals can convert to stock companies through a process called demutualization. Demutualization. This is a very hard word, but just so you guys know, so you can write it down, so you can research it. It is DEMUTURALIZATION. I do apologize. I probably said that so fast. It was DEMUTURALIZATION. Demutualization. Stocks and mutuals company are often referred to commercial insurers. They both can write life, health, property, and casualty insurance. Strong assessment mutual insurers. Assessment mutual companies are classified by the way in which they charge premiums. A pure assessment mutual companies operates on the basis of loss sharing by group members. No premium is payable in advance. Instead, each member is assessed an individual portion of losses that actually occurs. An advance premium assessment mutual charges all premium at the beginning of the policy period. If the original premiums exceed the operating expenses and losses, the surplus is returned to the policyholders and as a dividend. However, if total premiums are not enough to meet losses, additional assessment are levied, against the members. Normally, the amount of assessment that may be levied is limited, either by state law or simply as the provision in the insurer's bylaw. All right, reciprocal insurers. Reciprocal insurers are similar to mutuals. Reciprocal insurers are organized on the basis of the ownership by their policy holders. However, with reciprocal, it is the policyholders themselves who ensure the risks of the other policyholders. Each policyholder assumes a share of the risk brought to the company by others. Reciprocal are managed by attorneys, in fact. So that's really the difference between them. One is managed by themselves and the other one by the attorney, in fact. Like the Lloyds of London. Lloyds of London, contrary to people's belief, Lloyds of London is not an insurer but rather an association of individuals and companies that individually underwrite insurance. Lloyds can be compared to the New York Stock Exchange, which provides the arena and a facility for buying and selling public stocks. Lloyd's function is to gather and disseminate underwriting information. It's pretty much just by helping associates settles claims and disputes, and through its members, underwriters provide coverages that might otherwise be unavailable in certain areas. Reinsurers are reinsurers are pretty much specialized branches of the insurance that are insurance industries pretty much that specialize pretty much on in insuring other insurers. Reinsuring and providing reinsurance is an arrangement by which an insurance company transfers a portion of a risk it has assumed to another insurer. A reinsurance takes place to limit the loss any one insurer would face should a very large claim become payable. Another per another yeah another way another per se, let's see. Another reason for a reinsurance is to enable a company to meet certain objectives, such as a favorable underwriting or mortality results. The company transferring the risk is called the seeding company. If you want, you could Google that word as well. Seeding is CEDING. Yeah, CEDING. The company assuming the risk is a common reinsurance contract between two insurance company is called treaty reinsurance, which involves an automatic sharing of the risk assumed. If that makes sense. Do not drink this at home. This is just what fuels me. All right. Let's see. In a reinsurance agreement, the insurance company that transfers its losses exposure its loss exposure to another insurer is called the primary insurer. Captive insurer is an insurer established and owned by a parent firm for the purpose of insuring the parent firm's loss exposure is known as a captive insurer. And this is like so interesting because how would we know this if we're actually not even learn about this? Like honestly, myself and I hear about this all the time, but like I never pay attention to these things. And now that I'm studying and learning about it, I'm like, wow, it makes complete sense, doesn't it? Risk retention group. A retention group is the RRG, is a mutual insurance company formed to ensure people in the same business, occupation or professional, example, pharmaceutical, like dentistry, or engineering, like such. Fraternal benefit societies insurance is also issued by fraternal benefit societies, which have existed in the United States for more than a century. Fraternal societies noted primarily for their social, charitable, and benevolent activities, have memberships based on religious, national, or ethnic lines. Fraternal first began offering insurance to meet the needs of their poor members, funding the benefits of a pure assessment basis. Today, few fraternal relies on an assessment system, most having adopted the same advanced funding approach others insurers use. To be characterized as a fraternal benefit society, the organization must be non-profit, like tomato. Sorry, have a large have a large system that includes ritualistic work and maintain a representative form of government which elected officers. Fraternal must be formed for reasons other than obtaining insurance. Most fraternal today issue group and annuities with many of the same provision found in policies issued by commercial insurers. Home services insurers, like home service insurers, are insurance is also sold through a special brand of to a special branch of the industry known as a home service or debit insurers, all known as home service insurers. These companies specialize in a particular type of insurance called industrial insurance, which is characterized by relatively small face amounts, usually 1,000 to 2,000, with premiums paid weekly. It's pretty dope. Pretty dope. It's pretty cool. I said. 1 second. All right. All right. Let's do this. Industrial insurance is also sold through a special branch of their industry known as home service or debt insurance. These companies specialize in a particular type of insurance called industrial insurance, which is characterized by relatively small face amounts, usually 1,000 to 2,000, with premiums paid weekly. Service providers offers benefits to subscribers in return to the payment of a premium. Pretty much, service providers benefits are offers benefits to subscribers in return for pretty much of paying your payment. You pay your payment, you get benefits in return. Benefits are in the form of service provided by the hospital or physician participating in the plan. They sell medical and hospital care services not insured. These services are packaged into various plans, and those who purchase these plans are known as subscribers, like your health insurance, your coverage through Aetna, blah, blah, whatever, you're a subscriber, okay? Another type of service provider is the health maintenance organization, the HMO. HMOs offer a wide range of healthcare services to member subscribers for a fixed periodic premium paid in advance of any treatment. Subscribers are entitled to the service of certain physicians or hospitals contractors to work with the HMO. Unlike commercial insurers, HMOs provide financial for health care, pretty much financial for health care plus the health care itself. HMOs are known for stressing preventive health care and early treatment programs. A third type of service provider is the preferred provider organization, the PPO. Under the usual PPO arrangement, a group desiring health care services, examples such as the ones you get from your employer or a union, will obtain prices, discounts, or special services from certain select health care providers in exchange for referring its employees or members to them. Home service or debit insurance companies specialize in industrial services, which is made up of a very small premiums that are paid weekly. Just touching base, I'm just catching, pretty much repeating the same thing for you guys. Okay, PPOs can be organized by employers or by health care providers themselves. The contract between the employer and the healthcare professional, whether a physician or a hospital, spells out the kind of service to be provided. Insurance companies can also contract with PPOs to offer services to insured. Government as an insurer. Federal and state government are also insured, providing what are commonly called a social insurance program, ranging from crop insurance to bank and saving and loan depositing insurance. These programs have far-reaching effects. Millions of people rely on these plans. The major difference between the two is that the government programs are funded with taxes and serve national and states' social purposes. Social insurance programs include the following: old age survivors and disability insurance, OASDI, commonly known as Social Security, Social Security Hospital Insurance, HI, and Supplemental Medical Insurance, SMI, commonly known as Medicare. Medicaid is one of them as well. HMOs are known for stressing preventive care and early treatment programs. Under the PPO arrangements, a group desiring health insurance will receive price discounts in exchange for referring its employees to them. The government plays a vital role in providing social insurance programs. These programs pays billions of dollars in benefits every year and affect millions of people. Self-insurers. Through self-insurance, it is not a method of transferring risk. It is important concept of understanding. Rather than transfer risk to an insurance company, a self-insurer establishes its own reserve to cover potential losses. Self-insurance is often used by large companies for funding pension plans and some health insurance plans. Many times, a self-insurer will look to an insurance company to provide insurance above a certain maximum level of loss. The self-insurer will bear the amount of a loss below that maximizes the amount. How insurance is sold. Insurance is sold by a variety of companies and methods. Most consumers purchase insurance through licensed producers who present insurance products and services to the public via active sales and marketing methods. Insurance producers may be agents who represent or particularly a particular company or broker who are not tied to any particular company and can represent many insurers' products. In a sales transaction, agents represent the insurer and brokers represent the buyer. An agent has an agent's contract, a broker has a broker's contract as well. Agents are also classified as captive or career agents and independent agents. A captive, a career agent, works for one insurance company and sells only that company's insurance policy. An independent agent works for himself and sells the insurance products of many companies. The agent's contract and appointment with the insurance company grants the authority to bind an insurer to an insurance contract. In any dispute between the insurance or beneficiary and the insurer, the agent will solicit an insurance application represent the insurer and not the insured beneficiary. In most states, however, the agent may represent as many insurers as will appoint him. There are three systems that support the sales of insurance through agents and brokers. These are the career agency system, personal producing general agency system, and independent agency systems. Career agency system. Career agencies and branches are branches of major stock and mutual insurance company that are contracted to represent an insurer in a specific area. In career agency, insurance agents are recruited, trained, and supervised by either a manager, employee, or the company, or a general agent, GA, who has a vested right in any business written by the GA's agent. GAs may operate strictly GAs may operate strictly as managers, or they may devote a portion of their time to sales. The career agency system focuses on building sales staffs. Personal producing a general agency system. The person producing a general agency PPGA system is similar to the career agency system. However, PPGAs do not recruit, train, or supervise career agents. They primarily sell insurance, although they may build a small sales force to assist them. PPGAs are generally responsible for maintaining their own offices and administrative staff. Agents hired by PPGA are considered employees of the PPGA, not the insurance company, and are supervised by regional directors. Independent agency system. The independent agency system, our creation of the property and casualty industry, does not tie the sales staff or agency to any one particular insurance company. Instead, independent brokers represent any number of insurance companies through contractual agreement. They are compensated on a commission or fee base for the business they produce. This system is also known as the American agency system. Other method of selling insurance. While most insurance is sold through agent or brokers under the system previously described as large volume, is also marketed through direct selling and mass marketing methods. With the direct selling method, the insurer deals directly with consumers by selling its policy through vending machines, advertisement, or salaried sales representative. No agent or broker is involved. A large volume of insurance is also sold through mass marketing techniques, such as over the internet or newspaper, magazine, radio, or television ads. Mass marketing methods provide exposure to large groups of consumers, often using direct selling method with occasional follow-up by agents. An agent representative, pretty much, an agent represent the insurance company, not the client or beneficiary. Agents can be captive, meaning they are employed by a company and only sell that company's product, which with direct selling, the insurer deals directly with the customer. No agent is involved. Evolution of industry oversight. The insurance industry is regulated by a number of authorities, including some inside the industry itself. The primary purpose of these regulations is to promote public welfare by maintaining the solvency of insurance companies. Other purposes are to provide the consumer protection and ensure fair trade practice, as well as fair contract at fair prices. It is very important insurance agents understand and obey the insurance law and regulation. Very important. I emphasize it is very important. However, history of regulation. A brief overview of the history of insurance regulation will show a seesaw between the authority of the states and the federal government. True balance between these two bodies has been reached and maintained for many years. Arguments favoring control by one governing authority over another are still being waged. 1868, Paul v. Virginia. This case, which was decided by the U.S. Supreme Court, involved one state's attempt to regulate an insurance company domiciled in another state. The Supreme Court sided against the insurance company, ruling that the sale and issuance of insurance is not interstate commerce, thus upholding the right of states to regulate insurance. In 1944, United States versus Southeastern Underwriters Associate (SEUA), the decision of Paul v. Virginia, held over for 75 years before the Supreme Court again addresses the issue of state versus federal regulation of the insurance industry. In the SEUA case, the Supreme Court ruled that the businesses of insurance is subjected to a series of federal laws, many of which were in conflict with existing state laws, and that insurance is a form of interstate commerce to be regulated by the federal government. This decision did not affect the power of state or regulation to regulate insurance, but it did not nullify state laws that were in conflict with federal legislation. These results of the SEUA case was the shift to the balance of regulatory control to the federal government. In 1945, the McCarran-Ferguson Act, the turmoil created by the SEUA case prompted Congress to enact Public Law of 15, the McCarran-Ferguson Act. This law made it clear that continued regulation of insurance by the state was in the public's best interest. However, it also made it possible to have the application of federal and antitrust laws to the extent that the insurance businesses is not regulated by state law. This act led each state to revise its insurance law to conform to the federal laws. Today, the insurance industry is considered to be state regulated. In 1958, intervention by the FTC. In the mid of 1950s, the Federal Trade Commission, the FTC, sought to control the advertising and sales literature used by the health insurance industries. In 1958, the Supreme Court held that the McCarran-Ferguson Act disallowed such supervision by the FTC. A federal agency, additional attempts have been made by the FTC to force further federal control, but none have been successful. The Fair Reporting Act, which requires an accurate reporting of information about consumers, must inform applicants about any investigations being made. If any consumer report is used to deny a coverage or a charge higher rates, and the insurer must furnish to the applicant the name of the reporting agency conducting the investigation. In 1959, intervention by the SEC. In this instance, the issue was variable annuities, or the insurance products to be regulated by the states, or the securities or to be regulated federally by the Securities and Exchange Commission (SEC). The Supreme Court ruled that federal securities laws apply to insurers that insures variable annuities and thus require these insurers to conform to both SEC and state regulation. The SEC also regulates variable life insurance. In 1970, Fair Credit Reporting Act, in an attempt to protect an individual's rights to privacy, the federal government passes the Fair Credit Reporting Act, which requires fair and accurate reporting of information about a consumer, including application for insurance. Insurers must inform applicants about any investigation that are being made. If any consumer report is used to deny coverage or charge higher rates, the insurer must furnish to the applicants the name of the reporting agency conducting the investigation. Any insurance company that fails to comply with this act is liable to the consumer for actual punitive damages. The maximum penalty for obtaining consumer information report under false pretense is 5,000 and 1 year imprisonment. 1999 Financial Services Modernization Act. The Glass-Steagall Act of 1933, which bared common ownership of banks, insurance companies, and securities firms, and erected a regulatory war between banks and non-financial companies, came under repeated act in 1980s. In 1999, Congress passed the Financial Service Modernization Act, which repealed the Glass-Steagall Act. Under this new legislation, commercial banks, investment banks, retail brokerage, and insurance company can now enter each other's lines of business. The chronology CT reflects the roles of the courts and the federal government have played in regulating the insurance industry. So pretty much, let's now take a look at how the individual state regulates the businesses and how the industry practices self-regulation. Agent marketing and sales practice. Marketing and selling financial products such as life insurance and annuity requires a high level of professionalism and ethics. Every state requires its licensed producers to adhere to a certain standard designated to protect consumers and promote a suitable sales and application of insurance products. Some of these standards are listed, such as we'll let you know now. Selling to needs. The ethical agent determines the client's needs and then determines which is best suited to address those needs. Two principles of needs-based selling includes find the facts and educate the client. Suitability of recommended products. The ethical agent assesses the correlation between a recommended product and the client's need and capability by asking and answering the following questions. By following question meaning, what are the client's needs? What products can help meet those needs? What does the client understand the product and its position, its provisions? Does the client have the capability financially and otherwise to manage the product? Is this product in the client's best interest? Five very important question. Full and accurate disclosure. The ethical agent makes it a practice to inform clients about all aspects of the product recommended, including benefits and limitations. There should never be an attempt to hide or disguise the nature or the purpose of the product nor the company being represented. Insurance agent or the insurance product are highly effective financial planning tools. They should be presented clearly, completely, and accurately. Documentation. The ethical agent documents each client meeting and a transaction. The agent uses fact-finding forms and obtains the client's written agreement for needs determined, the products best recommend, and the decision to best made. Some documentation is required by a state's law. Ethical agent known these laws and follow them precisely. Client services. The ethical agent known after that a sale does not mark the end of the relationship with a client but the beginning. Routine follow-up calls are recommended to ensure that the client's needs always are covered and the products are in place still are very suitable to the client's need. When clients contact their agents for services or information, these requests are given top priority. Complaints are handled promptly and fully. Buyer's guides and policy summaries to help ensures that the prospective insurance buyers select the most appropriate plan for their needs and to improve their understanding of basic products or features. Most states requires agents to deliver a buyer's guide to consumers whenever they solicit insurance sales. These guides explain the various types of life insurance product, including variable annuities, in the way that the average consumer can understand. In addition, a policy summary contain. I'm so sorry. So sorry. In addition, a policy summary containing information about the specific policy being recommended must be given to a potential buyer. It identifies the agent the insured the policy, and each rider includes information about premium, dividends, benefits amounts, cash surrender value, policy loan interest rates, and life insurance costs indexes of the specific policy being considered. Most states require this to be done before the applicant's initial premium is accepted. The policy summary also contains cost indexes that help the consumer evaluate the suitability of the recommended product. The net payment cost comparison indexes gives the buyer an idea of the cost of the policy at some future point in time compared to the death benefit. The surrender cost comparison index compares to the cost of surrendering the policy and withdrawing the cash values at some future time. Because all states are interested in protecting the interests of the buying public, the actions of individuals soliciting insurance sales are strictly regulated. However, the laws regarding insurance marketing and trade practices may vary from state to state. As a result, it is very important that you are examine and understand your state's laws. National Association of Insurance. Ugh, I'm so sorry. National Association of Insurance Commissioner. All states of insurance commissioner are directors of members of the National Associations of Insurance Commissioner, NAIC. Sorry. This organization has committees that work regularly to examine various aspects of the insurance industry and the recommended appropriate insurance laws and regulation. The NAIC has four broad objectives. Number one, to encourage uniformity in state insurance laws and regulations. Number two, to assist in the administration of those laws and regulations by prompting efficiency. Number three, to protect the interests of the policy owners and the consumers. Number four, to preserve state regulation of the insurance businesses. Keep in mind the NAIC has been instrumental in developing guidelines and models legislation that helps ensures that the insurance industry maintain a high level of public trust by conducting its businesses competently and fairly. This group also develops standards for policy provisions, helping ensure that policies are more uniform than this parrots across the country. Notable among the NAIC's accomplishment was the creation of the Advertising Code and the Unfair Trade Practice Act, which has been adopted by virtually every state. All right. Now we're learning about advertising code, and a principal problem of state is the past was in the past was regulating misleading insurance advertising and direct mail solicitation. Many states now subscribe to the advertising code developed by the NAIC. The code specifies certain words and phrases that are considered misleading and are not to be used in advertising of any kind. Also required under these codes is full disclosure of policy renewal, cancellation, and termination provisions. Other rules pertain to the use of testimonials, statistics, special offers, and the like. Unfair Trade Practice Act. Most jurisdictions have also adopted the NAIC's Unfair Trade Practice Act. This act gives chief financial officers the power to investigate insurance company and producers, to issue cease and desist orders, and to impose penalties on violators. The act also gives officers the authority to seek a court injunction to restrain insurers from using any method believed to be unfair or deceptive. Included in the context of unfair trade practices are a misrepresentation and false advertising, coercion, and intimidation, unfair discrimination, and inequitable administrations of claim settlement. State Guaranteed Association. All states have established guarantee funds or guarantee associations to support insurers and to protect consumers if an insurer becomes insolvent. Should an insurer be financially unable to pay its claim, the State Guarantee Association will step in and cover the consumer's unpaid claims. These states associations are funded by insurance companies through assessment. Ay, Dios mío. Claim settlement practice. Claim settlement practice of insurers are regulated by state insurance departments. The NARCO registry The do not call registry allows consumers to include their phone numbers on the list to which solicitation calls cannot be made by telemarketers. Calls made on behalf of charities, political organization, or surveys or all exempt or a service or exams really. Rating services, the financial strength and stability of an insurance company are two vitally important factors to potential insurance buyers and the insurance company. Guides out to insurance companies' financial integrity and claims of paying ability are published regularly by rating services such as AM Best, Fitch Rating, Standard and Poor's, Moody's, and Fitch. All right, let's see. MBES. MBES is a plus superior ability to meet ongoing obligation. Fitch rating. Fitch rating is more likely the a very strong capacity to meet policyholder and contract obligations. The Standards and the Poor's. Standard and Poor's or the AA are very strong financial security characteristics. Moody's. Moody's is the A1 good financial security. Basic insurance principles. We are exposed to many perils. The purpose of insurance is to provide economic protection against losses against causes by chance, such as death, illness, or accidental. This protection is provided through an insurance policy, which is simply a device to accumulate funds to meet these certain uncertain losses. The policy is a legally binding contract that sets forth the company's promise and obligation as follows, whereby for a set amount of money, the premium, one party, the insurer, agrees to pay to the other party, the insured, or the insured beneficiary, as set amount the benefit upon the occurrence of some or such event. In the case of the life insurance, for example, the benefit is paid when the insurer dies. In the case of health or disability insurance, the benefit is paid if and when the insured incurs certain medical expenses or become disabled as defined by the contract. Insurance is based on two fundamental principles: the spreading or pooling of risk, also known as loss sharing, and the laws of large number. To understand these principles, consider the following examples, such as the risk pooling. Risk pooling, also known as a loss sharing, spreads risk by sharing the possibility of loss over a large number of people, and it transfers risk from an individual to a group. You're transferring from one person to a group of people. Great. The nature of insurance. Assume that 1,000 individuals in the same social club agrees that if any members of their group dies, all members will pitch in to provide the deceased family with 10,000 to 10,000 with 10,000. This 10,000 it was, let's say, determined by them, right? This would pretty much provide the family with enough funds to cover the immediate costs associated with the death, and to provide the financial cushion for at least a few months, because it is not known when any one individual within the group will die. The decision is made to a pre-fund the benefit by assessing each member $10. Each individual contributes $10, thus creating a 10,000 fund. As you can see, without the agreement to help provide for each other's potential loss, each group member and then the family members would have to face the economic cost of a death alone. But by sharing the burden and spreading the risk of death over all 1,000 group members, the most of any members would pay would be 10 actual dollars. This is a simplified example, but it explains the basic concept of loss sharing. By spreading a risk or by sharing the possibility of loss, a large group of people can substitute a small certain cost of $10 for a large unknown risk. The economy risk is pretty much of dying. In other words, the risk is transferred from an individual to a group, each member of which shares a losses of a loss pretty much shares the losses and has the promise of a future benefit. Insurance companies pools risk amongst like thousands and thousands of insurers and apply certain mathematical principles to guarantee policies and the policy owners, and all of that is where the money will be there to pay a claim when it arises. As we will see, one of the basic factors of in life in health premium in the interest of earned by the insurance company or the premium or it received, and subsequently like the investment laws of a large number. Sorry. So the law of a large number, in addition of spreading risk among a large number of people, insurance relies on a principle that the larger the number of the individual risk or exposures really that are combined in a group, the more certainly there is in the amount of a loss incurred in any given period. In other words, given a large enough pools of risk, an insurer can predict with reasonable accuracy the number of claims it will face at any given time. No one can predict when any one person will die or if any one person will become disabled. That is true. That is pretty true. However, it is possible to predict the approximate number of deaths or the likelihood of disability that will occur among a certain group during a certain period. This principle, known as the law of large numbers, is based on the science of probability and the experience of mortality, death, and morbidity, sickness. Statistically speaking, a large group of similar risks will provide more accurate mortality and morbidity prediction. For example, statistics may show among a group of 100,000 of 30 years old males, 200 will die within a year. While it is not possible to predict who among 200 will die, the number will be accurate. However, a small group will not provide an accurate prediction. Among a group of 100 to 30 years old male, it is not statistically as feasible to predict if any of the group will die within a year, because insurance covers thousands and thousands of lives. If it is possible to predict when it is possible to predict when and to what extent death and disability will occur, and consequently like when claims will arise. So, it's easier when it's a larger number than when it's a lesser number with lesser people. So this is what the pretty much, the concept of a large. Yes, the concept of the law of the large numbers. However, all forms of insurance, life, health, accidents, property, and casualty relies on risk of pooling and the law of large numbers. These principles form the foundation upon which insurance is based and allow for its successful operation. As we have learned, insurance replaces this uncertainty of risk with guarantees. But what exactly does the word risk means, and how does insurance remove the uncertainty and minimize the adverse effects of risk? Risk defined. Risk can be defined as uncertainty regarding loss. Property loss, such as the destruction of a home due to a fire, is an example of risk. Negligence or careless can give rise of a liability risk if there is a potential injury to an individual or damage to the property. The inability to work and earn a living due to a disability is another example of risk, as is loss or if a family income due to a death or income provider. The loss that is involved with all these risks is characterized by a lessening or disappearance of value. the peril is a something that can cause a financial loss, such as an earthquake, a tornado. A peril can also be referred to as the accident itself, or loss is the unintentional decrease in the value of an asset due to a peril. Loss exposure is in any situation that presents the possibility of loss. Home Homogeneous exposure and units are similar objects of insurance that are exposed to the same group of perils. Types of risk. Risk can be divided into two classes: speculative risk and pure risk. Speculative risk and pure risk. I repeated it just so we could grasp it, because we're about to talk about this right now. Speculative risk. Speculative risk involves the chances of both lost gains and gains. Gambling at a casino or investing into the stocks market are example of speculative risk. There is a chance of for gain and a chance for loss. Therefore, speculative risks are not insurable. Pure risk. Pure risk involves only the chance of a loss. There is never a possibility of gain or profit. The risk associated with the chance of injury from an accident is an example of a pure risk. There is no opportunity to gain. The event does not occur. Only the opportunity for loss if it does occur. Only pure risks are insurable. With life insurance, the risk involved is when death will occur. It can be tomorrow, next week, next year, or well, right now as we speak, into the next future. I'm not sure. Loss can result if the death is premature or comes too late. With health insurance, the risk is not when, but if illness or disability will strike. Losses associated with health risk include medical losses or loss of income. With annuity, the risk is living too long or outlasting one's income. Annuity cover its risk by paying or guaranteed income to the annuitant for a specific period of time for life. I mean, you never know. Fire, gambling, like all of this, like those are things like people don't know, they're not aware of. The risk management. Risk management is a process of analyzing exposure that creates risk and designing programs to handle them as called risk management. Principle of amenity. Amenity. It's a very strong word. If you guys don't know it, you want to also jot it down. It is INDEMNITY. The principle of amenity involves making an insured road by restoring them to the same condition as before as loss. Adverse selection. Insurers must minimize adverse selection, which is defined as the tendency for a poorer than average risk to seek out insurance. For example, a person who takes 12 prescriptions is a poor risk. If an insurer cannot compensate poor risk with a better than average risk, then it losses experience will increase, and its ability to pay claims may be compromised. Reinsurance. One way and reinsurers deals with catastrophic loss is through reinsurance, which is defined as spreading risk for one insurer to one or more other insurers. Many insurers are able to minimize exposure to loss by reinsuring risk. Hazard. A condition or situation that creates or increases a chance of loss is called a hazard. Perils and hazard. In conjunction with risk or the concept of perils and hazards. Perils and hazard are factor that causes or give risk rises or give rise to a risk, pretty much. Sorry for my accent once again. I speak multiple languages. It gets very easy, but sometimes it gets very hard. Sometimes I flow right through it, and sometimes the accent get rough or the word is a bit different or difficult. Okay, so bear with me. Okay, so let's continue. A peril is defined as the immediate, specific event causing loss and giving rise to risk. A peril is the cause of a risk. For example, when a building burns, fire is the peril. When a person dies, death is the peril. When an individual is injured as an accident in an accident, the accident is the peril. When a person becomes healed from a disease, the disease is the peril. Physical hazard are individual characteristics that increases the chances of peril. For example, physical hazards may exist because of a person's physical condition, past medical history, condition of a birth, blindness or deafness, or physical hazard. Or they are all physical hazard. Moral hazard are tendency that people may have which increases risk or the chance of loss, alcoholism or drug addiction, and are considered moral hazard. Morally hazard are also individual tendencies, but they arise from an attitude or state of mind causing indifferences to losses. For example, a person may have a habit of driving recklessly with no fear of death or the injury. These indifferences or is a morally hazard, increasing the chance of death and injury. Treatment of risk. The way in which risks are treated varies greatly depending on the situation, the degree of potential loss, and the individual. Basically, there are four basic options: avoid the risk, reduce the risk, retain the risk, or transfer the risk. Let's consider each. Risk avoidance. One method of dealing with risk is avoidance. Avoidance, this simply means avoiding as many risks as possible. By choosing not to drive or own an automobile, one could avoid the risk associated with driving. By never flying, one could eliminate the risk of being in an airplane crash. By never investing in stocks, one could avoid the risk of a market crash. Clearly, risk avoidance is effective, but it is not always practical. Few risks can be handled in this manner. Risk reduction. Risk reduction is another means of dealing with risk. Since we cannot avoid risk entirely, we often attempt to lessen the possibility of loss by taking action to reduce the risk. Installing a smoke alarm in our home will not lessen the possibility of a fire, but it may reduce the risk of a loss of a home from a fire. Risk retention. The risk retention is another method of coping with risk. This means accepting the risk of and confronting it, and when it occurs. One way to handle the or retain risk is through self-insurance. Setting up a fund to offset the cost of the potential loss is considered as self-insurance. Risk transference.
Baba DeBoss Red Heart
Okay,
Heart
in
Suit.
just a moment.
Face with